Recessions terrify most investors. They see the headlines about layoffs and bankruptcies and declining consumer confidence, and they want to sell everything and hide in cash until it is over. But after 50 years of investing through multiple recessions, I've learned that recessions are actually the best time to buy stocks. The fear that drives others away creates the opportunities that build fortunes. The question isn't whether to buy during recessions. The question is what to buy. Today, I am going to share the only 3 stocks I would buy if we entered a recession tomorrow. These aren't speculative bets on recovery. They're not beaten down companies hoping to survive. They're exceptional businesses that will not only survive a recession, but emerge stronger from it. Businesses available at prices that provide genuine margin of safety. Businesses that represent the kind of asymmetric risk reward that I've spent my entire career seeking. Let me start by explaining my framework for recession investing, because the framework matters more than the specific stocks. Anyone can give you a list of stocks to buy. Understanding why those stocks are appropriate during recessions is what allows you to make good decisions on your own. The first principle is that recessions separate the strong from the weak. During economic expansions, almost every company looks good. Rising tides lift all boats. Weak companies can survive because credit is available. Customers are spending, and mistakes are forgiven. But recessions expose the truth. Companies with fragile business models fail. Companies with too much debt face bankruptcy. Companies that depended on favorable conditions discover they have no foundation when conditions turn unfavorable. This separation is actually good for the strong companies. When weak competitors fail, strong companies gain market share. When distressed assets come up for sale, strong companies can acquire them cheaply. When credit becomes scarce, companies with fortress balance sheets can operate normally, while competitors struggle. Recessions are when the strong get stronger, which is why I focus on strength when selecting recession investments. The second principle is that recessions create mispricing. In normal markets, stocks trade roughly in line with their intrinsic value. Buyers and sellers are reasonably informed, reasonably rational, and reasonably balanced. Prices aren't perfect, but they're not wildly wrong. During recessions, this breaks down. Fear dominates. Investors sell indiscriminately. They don't distinguish between companies that are genuinely impaired and companies that are merely caught up in the panic. Prices fall far below intrinsic value for the best companies because sellers need to raise cash and don't care about value. This mispricing is where the opportunity lies. If you can identify companies whose long-term value hasn't changed but whose stock prices have collapsed, you can buy dollars for 50 cents. You can establish positions that will generate extraordinary returns as prices eventually recover to reflect true value. But this requires the analytical skill to distinguish between impaired value and impaired price, and the emotional fortitude to buy when everyone is selling. The third principle is that margin of safety matters most during recessions. Margin of safety is the concept that you should only buy when the price is significantly below your estimate of intrinsic value. The gap between price and value provides protection. If your analysis is wrong, or if conditions deteriorate further. During recessions, margin of safety becomes even more important because uncertainty is elevated. You don't know how long the recession will last. You don't know how severe it will become. You don't know what cascading effects might occur. The margin of safety protects you against this uncertainty. I demand larger margins of safety during recessions than during normal times. If I would normally require a 20% discount to intrinsic value, I might require 30 or 40% during a recession. This means I buy fewer stocks, but the ones I buy are positioned to deliver strong returns, even if the recession is worse than expected. With this framework in mind, let me tell you about the 3 stocks I would buy in a recession. The first stock is Berkshire Hathaway. This might seem like an obvious choice, and in some ways it is, but the obvious choice is sometimes the right choice. And understanding why Berkshire is ideal for recession investing reveals important principles. Berkshire Hathaway is the most recession-resistant large company in America. This isn't because it is in a defensive industry. Berkshire owns businesses across dozens of industries, from insurance to railroads to manufacturing to retail. It is recession-resistant because of how it is structured and how it is managed. Start with the balance sheet. Berkshire holds over $300 billion in cash and treasury bills. $300 billion. This isn't laziness or lack of ideas. It is deliberate preparation for exactly the kind of opportunities that recessions create. When other companies are scrambling for liquidity, when credit markets freeze, when banks won't lend, Berkshire has more cash than it could possibly need. This cash provides absolute security. There is zero chance of Berkshire facing financial distress during a recession. Zero, but the cash is more than just protection. It is ammunition. During the 2008 financial crisis, Warren Buffett deployed Berkshire's cash into extraordinary deals. He invested $5 billion in Goldman Sachs at terms that would never be available in normal markets. He invested $3 billion in General Electric on similarly favorable terms. He made billions of dollars from investments that were only possible because he had cash when others desperately needed it. The same opportunity will arise in the next recession, and Berkshire will be ready. Consider the operating businesses. Berkshire owns Geico, one of the largest auto insurers in America. People need car insurance regardless of economic conditions. They might shop for lower rates during recessions, and Geico's low-cost model actually benefits from this because they win more price. Sensitive customers. Insurance premiums keep flowing into Berkshire during recessions. Berkshire owns Burlington Northern Santa Fe Railroad. Railroads are essential infrastructure. Even during recessions, goods need to move across the country. Rail volumes decline somewhat during downturns, but the business remains profitable because the fixed costs are already paid and incremental shipments are highly profitable. And railroads benefit from recessions in the long run because weaker trucking competitors go out of business. Berkshire owns Berkshire Hathaway Energy, one of the largest utility companies in America. Utilities are the definition of recession resistant. People need electricity, regardless of economic conditions. Rates are regulated, providing stable revenues. Capital expenditures can be adjusted if conditions deteriorate. Utilities are boring, which is exactly what you want during recessions. Berkshire owns dozens of other businesses, from Dairy Queen to Duracell to Precision Castparts. Some are more cyclical than others, but the diversification means that no single business can significantly impair the whole. If one segment struggles during a recession, others continue generating cash. The diversification isn't just across businesses, but across economic exposures. Now consider the management. Warren Buffett and his team have navigated more recessions than almost any other management group in corporate America. They know how to operate during downturns. They know how to maintain discipline when others panic. They know how to allocate capital when opportunities arise. And they have the temperament to remain calm when markets are chaotic. This experience and temperament is invaluable during recessions. Let me address valuation. Berkshire typically trades at a modest premium to book value, reflecting the quality of the businesses and management. During recessions, this premium often disappears or even inverts to a discount. In 2008 and 2009, you could buy Berkshire at prices that implied the market valued its operating businesses at essentially nothing, paying only for the investment portfolio. That was an extraordinary opportunity. The same mispricing could occur in the next recession. Even at current prices, Berkshire offers reasonable value. The stock trades at roughly 1.4 times book value. The operating businesses generate over $40 billion in annual earnings. The investment portfolio adds additional value, and the cash pile provides both protection and optionality. For recession investing, this is as close to a sure thing as exists in equity markets. The second stock I would buy in a recession is Johnson & Johnson. This company represents a different kind of recession protection, the essential nature of healthcare spending. Healthcare is one of the most recession-resistant sectors of the economy. People get sick regardless of economic conditions. They need medications regardless of unemployment rates. They require medical procedures regardless of stock market declines. The demand for healthcare is driven by biology, not economics. This biological demand provides stability that few other industries can match. Johnson & Johnson is the best company in healthcare for recession investing. It is diversified across three major segments: pharmaceuticals, medical devices, and consumer health. This diversification provides multiple sources of stability. The pharmaceutical segment is remarkably recession-resistant. When people have serious illnesses, they don't stop taking their medications because the economy is weak. Insurance and government programs cover most pharmaceutical costs, insulating patients from price concerns. And Johnson & Johnson's pharmaceutical portfolio is focused on critical therapeutic areas like immunology, oncology, and neuroscience, where the alternative to treatment is often suffering or death. Patients don't stop treating cancer because of a recession. The medical devices segment is more cyclical than pharmaceuticals. because some procedures can be delayed. Elective surgeries decline during recessions as patients postpone non-urgent procedures. But Johnson & Johnson's device portfolio is weighted toward essential procedures. Knee replacements might be delayed, but trauma surgery cannot be. Cardiovascular interventions cannot wait for economic recovery. The essential nature of most procedures provides stability even as the elective segment softens. The consumer health segment provides additional diversification. Brands like Tylenol, Band, Aid, and Listerine are staples that people continue purchasing through recessions. They might trade down to store brands in some categories, but Johnson & Johnson's brands have maintained market share through previous downturns because consumers trust them for health-related products where quality matters. Now, consider the balance sheet. Johnson & Johnson is one of only 2 companies in America with a AAA credit rating, the highest rating possible. This rating reflects decades of conservative financial management, consistent profitability, and modest debt levels. During recessions, when credit markets tighten and financing becomes expensive or unavailable, Johnson & Johnson has essentially unlimited access to capital at the lowest rates available. This financial strength allows them to operate normally when competitors struggle and to make acquisitions when distressed assets become available. The dividend is another crucial element. Johnson & Johnson has increased its dividend for over 60 consecutive years. 60 years. That includes every recession since the 1960s. Every single downturn, they not only maintained the dividend but increased it. This track record isn't just impressive history. It reflects a corporate culture and financial structure that prioritizes shareholder returns and has the stability to deliver them regardless of economic conditions. For recession investing, this dividend matters enormously. When stock prices are falling and the future seems uncertain, receiving steady dividend payments provides both income and psychological support. You are getting paid to wait for recovery, and if you reinvest those dividends during depressed prices, you are accumulating more shares at bargain levels, setting up for enhanced returns when prices recover. Let me discuss valuation. Johnson & Johnson typically trades at a premium to the market because of its quality and stability. During recessions, this premium compresses as investors sell indiscriminately. The stock might trade down to 15 or 16 times earnings, representing a significant discount to historical averages. That compression creates the buying opportunity. You are purchasing the same exceptional business at a lower price, simply because other investors are panicking. The current valuation is reasonable for a company of this quality. The stock trades at roughly 16 times forward earnings, with a dividend yield around 3%. If recession fears drive the price down further, the value proposition becomes even more compelling. This is exactly the kind of high-quality, recession-resistant business that deserves a place in any recession portfolio. The third stock I would buy in a recession is Costco. This might surprise some people because retail is often considered cyclical, but Costco is fundamentally different from other retailers. And understanding why reveals important principles about recession investing. Costco's business model is built for recessions. The company operates on a membership model where most of its profit comes from annual membership fees rather than product markups. Members pay to shop at Costco because the prices are significantly lower than anywhere else. During recessions, when consumers are focused on stretching their budgets, this value proposition becomes even more compelling. Costco doesn't suffer during recessions. Costco thrives during recessions. Think about the psychology of recession-era consumers. They're worried about their jobs. They're trying to reduce expenses. They're looking for ways to maintain their lifestyle while spending less. Costco offers exactly this. The same quality products at lower prices. The ability to buy in bulk and save money over time. The treasure hunt experience that makes saving money feel rewarding rather than painful. Everything about Costco's model aligns with recession-era consumer psychology. The membership model provides incredible stability. Members pay their annual fee at the beginning of the year, providing predictable revenue, regardless of what happens to the economy, and membership renewal rates consistently exceed 90%, even during recessions. Once people experience the value of a Costco membership, they don't give it up. They might reduce spending in other areas, but they keep their Costco membership because it saves them money on everything else. Consider the historical performance during the 2008 financial crisis. Costco's comparable sales grew, not declined, grew. While other retailers were collapsing, while consumers were cutting spending across the board, Costco was gaining share because its value proposition resonated more strongly during tough times. The same pattern appeared during previous recessions. Costco doesn't just survive recessions. Costco outperforms during recessions. The balance sheet is fortress. Like Costco carries minimal debt relative to its cash flows and could pay off all obligations easily. They don't need to access credit markets during recessions. They don't face refinancing risk. They operate from a position of strength while competitors struggle with over-leveraged balance sheets and demanding creditors. This financial strength allows them to maintain their low price model without compromise, while competitors raise prices or cut quality to survive. The management is exceptional. Costco has been led by disciplined operators who understand the business model and protect it fiercely. They resist the temptation to raise prices or cut quality for short-term profits. They invest in employees, paying well above industry average wages, which results in lower turnover and better customer service. They think long-term, which is exactly the mentality you want during recessions, when short-term thinking can be fatal. Let me address the valuation concern that often arises with Costco. The stock typically trades at a significant premium to the market, often 30 times earnings or higher. This seems expensive, and in absolute terms it is. But Costco earns that premium through consistent execution, recurring revenue, and recession-resistant growth. During recessions, the premium sometimes compresses as investors worry about consumer spending. That compression creates the opportunity. Even at current valuations, Costco represents good value for long-term investors. The business grows consistently. The membership model provides visibility. The recession-resistant nature reduces risk. And the competitive advantages are essentially permanent because no one can replicate the buying power and logistics that Costco has built over decades. For recession investing, the combination of defensive characteristics and growth potential is highly attractive. Now let me explain how these three stocks work together as a recession portfolio. Berkshire Hathaway provides diversified exposure to the American economy with extraordinary financial strength and opportunistic capital deployment. It is the foundation of the portfolio, offering stability through any environment and the potential for significant gains as Berkshire deploys capital during recession-created opportunities. Johnson & Johnson provides pure defensive exposure to healthcare, the most recession-resistant sector. The dividend provides income during uncertain times. The quality provides peace of mind. And the valuation compression during recessions creates the opportunity for significant appreciation as prices recover. Costco provides counter-cyclical exposure to consumer spending. While other retailers struggle during recessions, Costco gains share and grows earnings. This counter-cyclical nature provides portfolio diversification because Costco might actually perform better during recessions than during expansions. Together, these three stocks provide exposure to different aspects of recession dynamics. Berkshire benefits from deploying cash into distressed opportunities. Johnson & Johnson benefits from stable healthcare demand. Costco benefits from consumers trading down to value retailers. No single stock provides all of these benefits, but together they create a portfolio, well-positioned for recession conditions. Let me discuss how I would allocate among these three stocks. I would put approximately 40% in Berkshire Hathaway, 35% in Johnson & Johnson, and 25% in Costco. The higher allocation to Berkshire reflects its diversification and financial strength. The substantial allocation to Johnson & Johnson reflects the importance of defensive healthcare exposure. The smaller allocation to Costco reflects its higher valuation and more specialized nature. This allocation could adjust based on relative valuations at the time of purchase. If Costco's valuation compressed significantly during recession fears, I might increase its allocation. If Johnson & Johnson became extraordinarily cheap, I might weight it more heavily. The framework provides guidance, but specific conditions at the time of investment should influence the final allocation. Now, let me address some common questions about recession investing. First, people ask how to know when a recession is starting. This is the wrong question. Nobody can consistently predict when recessions will begin or end. Economic forecasting is notoriously unreliable. Instead of trying to time recessions, I focus on always owning businesses that can withstand recessions. If you own Berkshire, Johnson & Johnson, and Costco, you don't need to predict recessions. You are prepared for them whenever they arrive. Second, people ask whether they should wait for lower prices during recessions. Again, this is timing, and timing is unreliable. Prices might go lower, or the recession might be milder than expected, and prices might recover quickly. Instead of trying to catch the absolute bottom, I dollar cost average into positions during recessions. I buy some immediately when I decide to invest, then buy more if prices decline further. This approach ensures I participate in the opportunity while protecting against the risk of prices recovering before I've fully invested. Third, people ask about selling during recessions. Generally, the answer is don't sell. Selling during recessions locks in losses and prevents you from participating in the eventual recovery. The only reason to sell during a recession is if you need the money for living expenses, which is why maintaining adequate cash reserves outside your investment portfolio is so important. Fourth, people ask about diversification beyond these three stocks. For most investors, owning additional stocks during recessions is fine, but not necessary. These three stocks provide substantial diversification through Berkshire's many businesses, Johnson & Johnson's three segments, and Costco's unique positioning. Adding more stocks might reduce concentration, but also dilutes the quality. I would rather own 3 exceptional businesses than 30 mediocre ones. Let me share some thoughts on the psychological aspects of recession investing, because psychology often matters more than analysis. Recessions are emotionally difficult. Your portfolio declines in value. The news is relentlessly negative. People around you are panicking. Every instinct tells you to sell, to raise cash, to protect what you have left. Resisting these instincts requires understanding and conviction. The understanding comes from recognizing that recessions are temporary. They always have been. Every recession in American history has eventually ended. The economy has recovered. Stock prices have reached new highs. There is no reason to believe the pattern won't continue. Understanding this provides the intellectual foundation for holding on during difficult periods. The conviction comes from knowing what you own. If you own Berkshire Hathaway, you know that Warren Buffett is deploying capital into exceptional opportunities. If you own Johnson & Johnson, you know that people are still taking medications and receiving medical care. If you own Costco, you know that consumers are flocking to value retailers. The businesses continue operating regardless of what stock prices do. Conviction in the businesses allows you to ignore the stock prices. The combination of understanding and conviction allows you to not just hold on during recessions, but to buy more. The best investors I've known actually get excited during recessions because they see the opportunities. They're not paralyzed by fear. They're motivated by the chance to buy exceptional businesses at bargain prices. Developing this mindset is perhaps the most valuable thing any investor can do. Let me close with some thoughts on why recession investing matters for long-term wealth creation. The mathematics of investing reward those who buy during recessions. When you buy stocks at depressed prices, your future returns are higher because you are starting from a lower base. A stock that falls from $100 to $50 and then recovers to $100 has gained 100% from the low. If you bought at the low, you doubled your money. If you sold at the low and bought back at the recovery, you missed the entire gain. This mathematics is why the best investors emphasize buying during fear and selling during greed. The emotional difficulty of buying during recessions is what creates the opportunity. If it were easy, everyone would do it, and the opportunities wouldn't exist. The difficulty is the source of the reward. The 3 stocks I've described, Berkshire Hathaway, Johnson & Johnson, and Costco, represent the best opportunities I know of for recession investing. They combine defensive characteristics with quality businesses and reasonable valuations. They can be held confidently during the worst periods because their fundamental strength is unquestionable. And they offer substantial upside as prices recover to reflect intrinsic value. If we enter a recession tomorrow, these are the only 3 stocks I would buy. Not because other stocks might not do well, some will, but because these 3 represent the highest confidence opportunities available. They minimize the risk of permanent loss while maximizing the potential for substantial gains. They allow me to invest aggressively during recessions without losing sleep over whether I've made a mistake. That combination of opportunity and peace of mind is rare in investing. It is especially rare during recessions when fear dominates and mistakes are easy to make. Finding investments that offer both substantial returns and psychological comfort is the goal of recession investing. These 3 stocks deliver on both dimensions. The next recession will come, they always do. When it arrives, remember what I've told you. Remember that recessions separate the strong from the weak. Remember that mispricing creates opportunity. Remember that margin of safety matters most when uncertainty is highest. And remember that Berkshire Hathaway, Johnson & Johnson, and Costco represent the kind of recession investments that build lasting wealth. The opportunity is coming. Be ready for it. And when fear is at its maximum, when everyone is selling, when the headlines are screaming disaster, remember that this is exactly the time to buy. That is how fortunes are made. That is what 50 years of investing has taught me. And that is why these three stocks are the only ones I would buy in a recession. Let me expand on some additional considerations that will help you implement this recession investing approach effectively. One question I often receive is about timing, not market timing in the sense of predicting recessions, which I've already dismissed as impossible, but timing in the sense of how quickly to deploy capital once a recession begins. This is a legitimate question because recessions unfold over time and prices often continue falling after the initial decline. My approach is to invest in tranches rather than all at once. When I decide to build a recession portfolio, I might deploy 1/3 of my intended capital immediately. This ensures I participate in the opportunity. Even if the recession is short and recovery is quick, then I deploy another third if prices fall further, say another 15 or 20%. This allows me to take advantage of deeper discounts while maintaining reserves. The final third I hold in reserve for either exceptional opportunities or to complete positions during the recovery phase. This tranche approach addresses both the risk of missing the opportunity by waiting too long and the risk of deploying all capital at what turns out to be only the beginning of the decline. It is a middle path that acknowledges uncertainty while maintaining exposure to the opportunity. Another consideration is how to source the capital for recession investing. The best recession investors don't find capital during recessions. They prepare capital before recessions. This means maintaining a meaningful cash allocation in your portfolio during normal times, even though cash generates lower returns than stocks during bull markets. The opportunity cost of holding cash during good times is more than offset by the ability to deploy that cash during recessions when prices are depressed. I recommend maintaining at least 15 to 20% of your portfolio in cash or short-term bonds during normal times if you want to be positioned for recession investing. This isn't a drag on performance when viewed over full cycles, because the gains from deploying that cash during recessions compound for years afterward. The investors who have no cash during recessions miss the best opportunities entirely. Related to this is the concept of dry powder at the business level. One reason I favor Berkshire Hathaway so strongly for recession investing is that Berkshire maintains its own dry powder. The company's $300 billion cash pile means that even if you don't have personal capital to deploy during recessions, you are invested in a company that does Berkshire's recession. Investments generate returns that flow through to shareholders. You are essentially getting professional recession investing through your ownership of Berkshire. Let me discuss the role of dividends in recession investing, because dividends matter more during recessions than at any other time. When stock prices are falling and capital gains are negative, dividends provide positive returns that partially offset the price decline when uncertainty is high and the future is unclear. Dividend payments provide tangible evidence that the business is still generating cash and rewarding shareholders. When prices are depressed, reinvested dividends buy more shares at lower prices, setting up for enhanced returns during recovery. 2 of the 3 stocks I've recommended, Johnson & Johnson and Costco, pay meaningful dividends. Johnson & Johnson yields around 3% with 60-plus years of consecutive increases. Costco yields less, around 0.5%, but has grown its dividend rapidly. Berkshire famously pays no dividend, but the cash it retains is deployed into opportunities that generate returns for shareholders. All 3 companies return value to shareholders, whether through dividends, buybacks, or reinvestment. During recessions, I reinvest all dividends rather than taking them as income. This automatic reinvestment is a disciplined way to buy more shares at low prices without requiring active decisions. Every dividend payment puts more money to work at depressed valuations. Over time, these reinvested dividends compound into significant additional wealth. The investors who spend their dividends during recessions miss this compounding opportunity. Let me also address the question of how long to hold these recession investments. The answer is indefinitely. or at least until valuations become clearly excessive. These aren't short-term trades to be sold when prices recover. These are long-term investments in exceptional businesses that happen to have been purchased at attractive prices during recessions. The mistake many investors make is selling too early during recoveries. They see their portfolios recover to pre-recession levels and think they should take profits. But if the businesses are still excellent and valuations are still reasonable, why sell? The gains from holding exceptional businesses for decades far exceed the gains from trading in and out based on short-term price movements. I've held some investments for over 30 years. The businesses have grown, dividends have compounded, and values have multiplied many times over. None of that would have happened if I'd sold when prices recovered to some arbitrary level. The real wealth in investing comes from holding exceptional businesses. The reason it's full cycle, not from trading around short-term fluctuations. Let me share some historical context that illustrates why these three stocks are appropriate for recession investing. During the 2008 financial crisis, Berkshire Hathaway's stock price fell from around $150,000 per share to around $70,000, a decline of over 50%. This was terrifying for shareholders who watched the value of their investment cut in half. But Berkshire's intrinsic value didn't decline by 50%. The businesses kept operating, the insurance premiums kept flowing, the railroad kept shipping goods, the utilities kept generating electricity, and Warren Buffett was deploying the cash pile into extraordinary opportunities. Investors who bought during the depths of the crisis. When Berkshire traded at or below book value, earned returns exceeding 300% over the following decade. Not because they were lucky, but because they recognized that the price decline far exceeded any decline in intrinsic value. They bought dollars for 50 cents and waited for the market to recognize the value. Johnson & Johnson showed similar patterns. The stock declined from around $70 to below $50 during the crisis, a decline of around 30%. But Johnson & Johnson's businesses barely noticed the recession. Pharmaceutical sales remained stable. Medical device procedures continued. Consumer health products kept selling. The company raised its dividend during the recession, demonstrating the strength and stability of its cash flows. Investors who bought Johnson & Johnson during the crisis captured both the dividend income and the price recovery. The stock tripled over the following decade while paying growing dividends every year. The recession created the opportunity, and patient investors who recognized the quality of the business were rewarded handsomely. Costco's performance during 2008 was even more remarkable. While the stock price declined along with the market, the business actually improved. Comparable store sales grew, membership renewals remained above 90%. New members signed up, attracted by the value proposition. Costco emerged from the recession stronger than it entered, with higher market share and more loyal members. Investors who recognized Costco's counter-cyclical nature and bought during the recession earned returns exceeding 500% over the following decade. The recession accelerated Costco's growth by driving value-conscious consumers toward its low-price model. What looked like a crisis for retail was actually an opportunity for Costco. These historical examples illustrate why quality matters so much during recessions. Lesser companies might not survive. Their stock prices might decline and never recover because the businesses themselves are permanently impaired. But exceptional companies like Berkshire, Johnson & Johnson, and Costco emerge from recessions stronger than ever. Their stock price declines are temporary while their intrinsic value continues growing. Buying during the temporary decline and holding through the permanent value creation is how recession investing generates extraordinary returns. Let me also discuss what I would avoid during recessions. Because knowing what not to buy is as important as knowing what to buy, I would avoid highly leveraged companies. Debt that seems manageable during good times becomes crushing during recessions. Revenue declines, while debt service remains constant. Companies that were profitable become unprofitable. Cash flow that comfortably covered interest payments suddenly falls short. Bankruptcies, restructurings, and equity wipeouts become common. The companies I've recommended all have conservative balance sheets, specifically because leverage is dangerous during recessions. I would avoid companies dependent on discretionary spending. When consumers cut back, they cut discretionary spending. First, travel, entertainment, luxury goods, and non-essential retail all suffer during recessions. Companies in these sectors might have been excellent investments during expansions, but they become value traps during recessions as their earnings collapse and take years to recover. The companies I've recommended either sell necessities like healthcare products or benefit from consumers trading down to value options. I would avoid companies with unproven business models during expansions. Investors tolerate companies that don't make money because growth seems to justify losses. During recessions, patience evaporates, funding dries up. Companies that depended on continuous capital raising find themselves unable to survive. The companies I've recommended have proven business models with long track records of profitability through multiple cycles. I would avoid trying to catch falling knives in distressed situations. Some investors seek out the most beaten down stocks during recessions, reasoning that the biggest declines offer the biggest potential gains. Sometimes this works. Often it doesn't. The companies with the biggest declines are usually the ones with the biggest problems. Distinguishing between temporary distress and permanent impairment requires expertise that most investors don't have. I prefer to buy high quality at reasonable prices rather than low quality at cheap prices. Let me share some thoughts on the emotional discipline required for recession investing, because this is where most investors fail. Recession investing requires buying when everything feels wrong. The economy is weakening. Unemployment is rising. The news is relentlessly negative. Your portfolio is declining in value. Friends and family are telling you to sell. Every instinct says to seek safety, and yet the right action is to buy more of the stocks that are falling. This emotional discipline doesn't come naturally. It must be developed through understanding and practice. The understanding comes from studying market history and recognizing that recessions end, that prices recover, that patient investors are rewarded. The practice comes from actually living through recessions and observing the pattern firsthand. If you've never invested through a recession, you are at a disadvantage. You don't have the experiential knowledge of how it feels and how it resolves. You'll be more susceptible to panic and poor decisions. One way to prepare is to study previous recessions in detail. Read about how investors felt during the 2008 crisis. Look at the headlines. Examine the price charts. Understand intellectually what you'll face. Emotionally, this preparation won't eliminate the difficulty, but it will help you recognize what you are experiencing and maintain discipline. Another way to build emotional discipline is to start small. If you are uncertain about your ability to hold on during a recession, don't deploy your entire portfolio into recession investments. Start with an amount you can afford to see decline further without panicking. As you observe your own emotional reactions and the eventual recovery, you'll build confidence for larger positions in future recessions. Finally, let me address why I am sharing this publicly. Some people wonder why successful investors reveal their strategies when doing so might reduce the opportunities available to them. The answer is that markets are enormous, and my purchases don't meaningfully affect prices. But more importantly, I believe in the value of education. Too many investors make catastrophic mistakes during recessions because they don't understand how to invest during them. If sharing my approach helps even a few people avoid those mistakes, that is valuable regardless of any impact on my own returns. The three stocks I've described represent my highest conviction recession investments: Berkshire Hathaway for its financial fortress and opportunistic capital deployment, Johnson & Johnson for its defensive healthcare exposure and dividend stability, Costco for its counter-cyclical consumer value proposition. Together, they form a portfolio designed to not just survive recessions, but to profit from them. When the next recession arrives, remember what you've learned. Remember that quality companies become available at discounted prices. Remember that fear creates opportunity for those who remain disciplined. Remember that the gains from buying during recessions compound for years afterward. And remember that Berkshire Hathaway, Johnson & Johnson, and Costco represent the kind of exceptional businesses that reward patient owners through any economic environment. The recession will be difficult. They always are. But for investors who understand these principles and maintain discipline, recessions are opportunities, not threats. They're when fortunes are made, not lost. They're when the foundation is laid for decades of wealth creation. These are the only three stocks I would buy in a recession, not because they're the only good companies, but because they represent the highest quality, most recession-resistant opportunities available. Buy them, hold them, and let time and compound interest do their work. That is recession investing at its best. That is what 50 years of experience has taught me, and that is the approach I'd use to protect and grow $1 million through any recession that might come.